The question on the minds of investors today is, when will the Fed raise rates? Deepika Sharma, Managing Director of Investment Research for Aster Investment Management, shares her perspective on what the Fed has been saying.
At August Jackson Hole meeting, Fed Chair Yellen did not signal any significant change from previous speeches. Consumption inflation came out to be below target at 1.6% and expected to hit 2% only over the next few years. Because of this, the employment situation and global risks remain the topmost factors for the Fed. However, slow payrolls growth for August of 151K dimmed prospects of an imminent hike. The Fed's Labor Market Conditions Index, which combines 19 labor market indicators, including quit rate, wages, and part-time workers, also slipped back to negative in August and has been negative for 7 out of 8 months. In addition, the weak manufacturing PMI is signaling lower growth. But one print doesn't directly affect the Fed's decision. If we look back at December, when the Fed finally raised rates by 25 basis points, ISM manufacturing was at 48 versus 49.4 today. Overall, the FOMC seems to think that the US will grow more slowly in the future, with GDP growth around 1.8 to 2%, whereas they were hoping for close to 2.5% just a few years ago. Right now, the market probability of a Fed hike for September 21 meeting is 24%, and for the December meeting is over 50%. Let's just examine what will happen if and when the Fed does hike. While it's clear how the front end of the curve will react, the outlook for US growth is key to understand how the dollar and longer dated bonds will move in response to a Fed hike news. Based on our reading of the economy using the Aster Economic Index, fundamentals are slightly worse, but still within a stable range compared to the numbers during the last Fed hike. Our view is that unless economic conditions deteriorate significantly in the next few months, we will expect a stable to steeper yield curve and higher rates by early 2017. One of the concerns market investors have is around the response of interest rate sensitive sectors to the next Fed hike. Here we'll point to the Atlanta Fed's shadow Fed funds rate calculations, which estimate the level of Fed funds rate that equals the amount of QE. Based on these calculations, we are already in a mature tightening cycle with a de facto hike of 337.5 basis points since the first half of 2014. Just like in December last year, a single hike is not relevant. It's the path of interest rates that matters for investors. Right now, the market's view of the path is very different from the Fed's, as seen in the Fed dot plot. Fed's forecast shows a 70% chance Fed's funds rate is between 0 and 325 basis points by the end of 2017, which really doesn't hold in the face of the reading of the business cycle today.
To find out more about how Aster can provide you with portfolio solutions, please visit our website at www.asterim.com.